Welcome back! In this video, we're going to look at withdrawal bonuses. So specifically, we're looking at partnerships. Let's just do a quick review. Pause the video and try and answer these two questions. What are bonuses in relation to admission and withdrawal of partners? And second question, what are some reasons for bonuses? The first, well, it's going to be the difference between the price paid to admit or withdraw a partner and the actual capital balance. Some reasons for this? Well, there may be a difference between what's actually happening in the market and what's on the books. So a difference between the market value and book value. Additional effort from signing or starting partners, and they could be bringing in more income from clients. So it may not be representative in the exact capital balance at that moment, as there may be more money coming in from them. Let's take a look at bonuses for departing partners. Reasons for bonuses when withdrawing. Well, again, the fair market value of the partnership is not equal to the net book value. It may be greater. Unrecorded goodwill existing from partners, superior earnings. So they may have done a really good job, and therefore they may want to get some sort of a bonus for their extra efforts. Third, remaining partners are anxious to remove partner from the firm. So it's almost like it's a payoff to try and get rid of them if they feel like they're not pulling their weight. Let's take a look at our first example. Here is a bonus to a departing partner. J. Adams, who currently has a capital balance of $200,000, decides to leave, and the current partners agree to pay him $250,000 cash from the partnership, and the bonus is to be split according to the income ratio of 1:1. Journalize the withdrawal. So, how does this actually work? It's going to involve capital balances. I'd encourage you to pause at this point and try and see if you could come up with an answer. How much will the other partners get? The bonus is going to be the payout, which is $250,000 minus what the capital balance is on the books. So it's $250,000 minus $200,000. Who's getting the bonus? Well, it looks like J. Adams is. So it means that the capital balances of the other two partners is going to go down. P. Singh pays half, which is 50%, and A. Galley pays 50%. Where does this come from? Well, the ratio is 1:1. So if we're to do 1 plus 1, the total parts is 2. And if it's being split 1:1, then it means half is being paid by one partner, and the other half is being paid by a second partner, so 50-50. Do you think you could come up with a journal transaction for this? What will it be? Well, half of the 50,000 is going to be 25,000. And remember that a capital balance is typically on the credit side. So here the bank ends up being withdrawn or decreased, credited by 250,000. J. Adams is going to be off the books with 200,000. And that also means that P. Singh and A. Galley's capital will decrease by 25,000 or be debited. Bonus to remaining partners. Well, cash can be paid to leaving partner is less than their capital balance. Reason for bonuses to remaining partners? To record assets that are overvalued. The partner is leaving, has poor earnings record. The partner is anxious to leave the partnership. So this is when we end up having a bonus being paid to the current partners or the remaining partners. Let's take a look at our second example. J. Adams decides to leave, and it is agreed that the current partners will pay him $200,000 cash. The bonus will be determined by a fixed ratio of remaining partner capital balances. Journalize the departure. I'd encourage you to pause at this point. Also note here that these are the capital balances and the partners. What do you think this journal entry is going to look like? Let's take a look. First, we need to calculate how much the bonus is. Well, in this case, J. Adams is only getting $200,000, yet on the books, it shows that he has a capital of $250,000. So the bonus to the remaining partners will be $50,000. How will it be shared? According to the question, it says the bonus will be determined by a fixed ratio of remaining partner capital balances. What are those capital balances? 150,000 for P. Singh, and 200,000 for A. Galley. What's the total? The total, if we were to add these together, is 350,000. So P. Singh should get 150 divided by 350,000, whatever that is as a percentage, and A. Galley will get 200,000 divided by 350,000. That works out to roughly 42.857% for P. Singh, and A. Galley gets roughly 57.143. Typically, what you should be doing is you should be taking the ratios and multiplying it by the 50,000 to make sure that there's no round off, or chopping errors. So, what does it actually work out to be? Before you take a look at the answer, we're going to take 42% of the 50,000 and 57% of the 50,000. These are bonuses that go to them, so we should be crediting that amount to each person. And we're getting J. Adams off the books. That means we're going to debit 250,000. We're going to be crediting bank 200,000, and whatever the difference is here will end up working out to P. Singh having a credit balance or credit of 221,428.57, and A. Galley 28,571.43. This is challenging stuff. It's not easy. So if you didn't get this in the first try, that's okay. That's why you get more time to practice. Well, this is going to be much more complex. So let's take a look at what this question is actually saying. Read it carefully. S. Purwal, R. Sidhu, H. Birdie, and A. Sheikh formed a partnership with a current capital balance of 200,000, 175,000, 300,000, and 225,000 respectively. Again, respectively means that the numbers listed here match up with the names above. So 200,000 is matched to Purwal, 175 to Sidhu, and so on. On November 16th, R. Sidhu plans to leave and will be paid based upon the following. S. Purwal, H. Birdie, and A. Sheikh pay 30,000, 25,000, and 45,000 from personal assets, respectively. The partnership pays $60,000 cash and $30,000 worth of accounts receivable with an allowance for bad debts of $1,000 and a car with a book value of $20,000 and accumulated depreciation of $14,000. The market value of the car is $8,000. And finally, the distribution of capital will be determined as a percentage of capital balances and personal asset payments. Journalized withdrawal. How much is the bonus and who gets it? This is pretty darn complicated. Try and break this into individual parts. Pause the video and try and do this on your own. I'd spend maybe about 5 to 6 minutes seeing what you can do with this before you see the answer. Let's take a look at the bonus calculation. We know that the current capital balance is $175,000. We also know that personal assets from all the other partners are being paid out of $30,000 plus $25,000 plus $45,000, which adds up to $100,000. We also know that the partnership is paying $60,000 from pocket. There's also a vehicle and accounts receivable being given. The net book value of the accounts receivable is $30,000 minus $1,000, which is $29,000. And the vehicle, because we're clearing it off the books, the market value doesn't matter. What does matter is the book value. The net book value of the car is $20,000 minus $14,000, which is $6,000. So when we get rid of this off the books, we need to make sure that these will just disappear and go into nothingness. The bonus will then be calculated as the capital balance minus these numbers, which will be 175 minus 100,000 minus 60,000 minus 29,000 minus 6,000, which is a minus $20,000. What does that mean? It means that this person who's leaving is going to get $20,000 more than their capital balance. That means that the leaving partner is getting the bonus. So R. Sidhu is getting the bonus, and that also means that the other partners will have a decrease in their capital balances. But how much? How much will it decrease by? According to the problem, the decrease will be determined by their capital balances. So we need to find out, and this is the most complicated part, is how much what percentage should each partner get? In this case, Purwal had a capital balance of $200,000 and they gave personal assets of $30,000. It's almost like you could have taken all those personal payments and put them in as a capital a capital investment before you end up doing the dispersion. The other way of looking at it, 200,000 plus 30,000 is 230. 300,000 for Verdi plus $25,000 payment is 325. Shake would be 270. The total capital plus the personal assets paid will be 825,000. As a percentage, what does that work out to be? Well, this will be 230,000 divided by 825, 325 divided by 825, and 270 divided by 825. But how much are we actually distributing? How much of their capital balance is going to go down by? Let's take a look. We know that Arcedu's capital is going to be 175,000. We know that Arcedu will end up getting $60,000 in cash, that the accounts receivable as a total will be 29,000, and the net book value of the vehicle is 66,000. That means that $80,000 has to be decreased from the capital balances, and that's going to be dispersed according to these percentages here. So what will this look like? Well, pretty complicated. We know that we have the capital balance gets cleared off. It's typically a credit account, so we debit, and Arcedu's capital will be off the books. The allowance for bad debts is typically a debit account. To get it off the books, we debit it, $1,000. And your accounts receivable, same idea. It's usually a debit account, except we're going to credit it $30,000. Same idea with the car. The car has a value of $20,000, which we end up crediting to get it off the books, and it had accumulated depreciation, which is the contra account. We debit it $14,000. The hardest part about all this stuff is these capital balances, coming up with that number of $80,000. Challenging stuff, but once we have everything down pat, we're good. So, to calculate the change in the capital balances, the decreases, we end up having 80,000 minus the percentages based upon the capitals as ratios. So 80,000 times 27.879% turns out to be 22,303.2, and so on. It's pretty complicated stuff. It's not easy. But you do have another assignment which will help you along and give you a little bit more time to absorb and learn from this. That's it for now. There are some additional questions to help you practice. If you felt overwhelmed, that was a really complex example. Don't feel bad. It takes time to get through and fully understand everything. I encourage you also to go back and try and do that problem again the next day and see if you could do it without the notes. As usual, if you have any questions, throw questions up into the stream or email me. Thank you for now.